Good morning, everyone. We are live at the Capitalmind Wealth webinar on how we use momentum to discover great stocks. It's a very interesting. It's going to be a very interesting webinar. It's going to be a little long, but it's definitely going to keep you occupied all through this. Me, Deepak, Shenoy, at Capitalmind, and we have Anoop, Vijaykumar, who's at Calm Investor on Twitter and manages the momentum portfolios at Capitalmind Wealth and the small case and premium portfolios as well. So big hi from all of us. So we'll take this presentation in two parts. First, I'll speak, and then the meat of the presentation is going to be from Anoop. So let me just switch over. We're at 11:01, so we should be starting. Please note that you can put your questions in the YouTube comments. We'll answer the questions right at the end. And if you, of course, if you need any more, we can always take more questions towards the end. Akanksha will be filtering and putting the questions up as well. And in case you need any support, just holler. Okay, so here's how we use momentum to discover great stocks. I'm going to take you through the initial part of the presentation, but first, I'll talk about how I got interested in momentum on trends and the concept, and therefore how sometimes it feeds back on many times. In fact, it feeds back into fundamental analysis as well, and therefore great tool for discovery. We've also, Anoop will then take us through how a quantitative momentum strategy works. So it's not just, Deepak and I looking at charts and stuff like that. It's actually a very, very well-refined strategy that has very interesting characteristics. And of course, very we'll go through what you might feel, oh man, this is just, how can this work at all? This is so anti everything else that's been taught in books. And there are, of course, pitfalls to consider, and we'll go through live examples as well. And at the end, we'll put Q&A. Before we go in, and I'm going to make this slightly high upper screen, big screen here, is nothing in this presentation should be construed as financial advice. We are a portfolio manager registered with SEBI, and you must, if we are to provide any feedback on any personal level, it has to be done through a risk profile analysis and so on. Please do your research. Actual returns will obviously vary because this is past performance. It's not guaranteed for future returns. Investments in securities involves risks, so none of this is risk-free. And of course, you'll know exactly what we mean by that in the presentation. And of course, we're interested in these stocks. Please assume we are interested in these stocks because we run portfolios and we advise on portfolios. So therefore, we are interested in all of the securities mentioned in this presentation. Do consider there's a link on Capitalmind disclosure that will be in the notes as well. Also, on as a PMS, we report all our returns post taxes, post transaction costs and post fees. But you must be aware of our charges and expenses before you think of anything. Alrighty, now we're done with that. We start with the meat of the presentation. Is first. The first time I got interested in momentum in a very serious way, I was from a fundamental perspective, was this very interesting stock. Now, this is a legendary stock. It's called TTK Prestige. Why is it legendary? Because TTK was started by the person named T.T. Krishnamachari, who was India's first finance minister, longest known, a huge brand company, in the sense they would actually sell retail distribution of brands. Then they start their own. They did a lot of things around pressure cookers and a bunch of kitchen implements, if you may. And around in 2000, if you can see this slide more carefully, you can see how. Okay, here you go. Yeah. So you can see how this particular stock was actually languishing. This is now a 1:10 ratio. Okay, so this is not actually because there was a 1:10 split sometime recently. It was at the 100-200 levels, and I tweeted in December 2009 that this stock has started to make a new all-time high and is going up. I don't know why, but it's going up. It was the at that time it had earned 20 rupees per share. It was 10 times this price. It was about 400 rupees. So roughly, um, 20 times earnings, which in today's day would be considered a value buy, but that time it was considered expensive. A lot of people said, why are you buying it at this level? This stock trades at 10 p most of the time. And I said, well, something's happening. I don't know what's happening. In a very short time, in about 1.5 years, things started to move. So the fundamentals changed. In the next year itself, by 2000, I think 2010 July, we had the results, and the results showed that the EPS had gone from 20 rupees to 46 rupees. Today's weight will be 2 rupees to 4.6 because it's 1:10 split. So you have a company who has more than doubled earnings, and even then it was at 800 rupees. And when it announced this increase in earnings, again, there was a fundamental factor to it which I realized later. But LPG had started to get popular. If you have LPG, then you can use pressure cookers to cook, instead of wooden wala stoves where you use open vessel cooking. Pressure cookers would be more efficient. So they would, I mean, if you use wood, for instance, you don't care how much wood is being used because relatively wood is cheap, but LPG is expensive. Therefore, you want to conserve the amount. Therefore, you will use a pressure cooker. This was happening alongside in India. Hawkins, the other large pressure cooker company, was getting famous in the north. Prestige was getting famous in the south for their pressure cookers. And then there were these ads and brands and all of that stuff. This company went on to make 3,000 rupees, which is now 300. In the chart, you'll see it says 300, but it was 3,000 rupees at the time, from 430 rupees in a rough space of 1.5 years. This is a company that has existed since 1928, so it's not really a fly of the mill kind of an operator, or you don't have major concerns on the fundamentals of this company. But for the longest time, this company did nothing. And then in a very short span, it went from the 400 levels to the 3,000 levels. And then in fact, it went to 3,500 before it reversed. And then it reversed, they lost some momentum at that time. And then when it had lost the momentum, let us say you had exited right at the bottom of it. Apologies for that. The right at the bottom of the momentum point, if you had gotten out, you would actually have still made 400%, which is 5x. That means your 100 rupees would have become 500 rupees at that time. This is very interesting because that story after this time, and it has been quite a while since. Okay, so the stock is now at 800 rupees. So this is 2012, it was 3,000, and now it's 8,000. So 800, so 300 and 800 is about 2.5 times. If you make 2.5 times in about 10 years, you're making about 8.5, 9, 10% a year, which is roughly the economic growth that India has had. So this company, which had massively grown earnings since the 2007 2008 timeframe to now, most of its stock market returns came in that little 2-year gap when the fundamentals actually changed, and that change happened underneath us. We weren't seeing it. If you're clued into the industry, perhaps much more clued in, you would have seen that the sales were growing quite dramatically. But you get sales figures only once in 3 months, right? So it takes time for even the market to realize that things have changed. But the prices were already changing. Somebody knew, and therefore were aware that this stock is probably severely underpriced from where it is. Today also, of course, it's priced at a much higher price to earnings ratio than it used to be, even at the top of 2012. But it's still a reasonable return since then. But most of the return has come in that one thing. The market cap was 500 crores then, and now it's 11,200. In fact, it went to 15,000 crore market cap and then came back. It's down about 30% from the top. But it's quite interesting. Now you might say, Deepak, what is this? Yeah, 500 crore stock when Nifty was 4,000. Okay, but even if Nifty is 4x now, which is 16, 17,000, this would have been a 2,000 crore stock. So is it only that momentum and all this stuff is only in small cap kind of stocks? Well, the answer is no, because there were India's largest company is Reliance in terms of free float market cap. Free float market cap companies is if it's the largest company, then how come you can see momentum in this? In 2006 January, there was a split between the brothers that was finally executed. Reliance Industries split into multiple companies, and the price fell. So you can see this little bar in the first green icon on the left where there's a formal split. So obviously Reliance is now less than what Reliance was earlier. Anil Ambani gets a bunch of companies. Therefore, Reliance price falls, but it starts to go back up. And within a few months, they released that there's an IPO of this company called RPL, Reliance Petroleum Limited, I think one of India's largest IPOs at the time. Reliance, by the way, is known for IPOs. In the 80s, every year you would IPO a different company. Eventually, they merged all of them together. RPL eventually was merged with RIL, and as we know it today. But RPL, the IPO that happened was a massive event in the sense it was so big that it brought the market down by 30%. Large IPOs tend to create liquidity issues in markets. We've seen this in the recent IPOs that happened in November. Since then, the market's been, not so kind. But overall, at that time, the markets fell 30%. So the Reliance stock also fell 30% but then after that, it started to go back up, and there was no major news flow. There was RPL, which was doing its own thing. There was Reliance, which was focusing on exploration and production of gas. And at the time, the rumor was that every time the Reliance stock would fall a little bit, Reliance would discover more gas in some KG basin or something like that. So that kept the news flow was both on and off. The earnings weren't spectacular. In fact, in 2007, in April, the stock didn't actually. I mean, the results were that profits grew only 20%. Now, the expectations were much higher, and we saw that the results, were ordinary for that one. But still, we were seeing that the stock is going up, and it was going up fairly remarkably. Largest company in India. You can't deny that this wasn't manipulated or anything like that. It was just that there was a steady flow. The market was also moving up. Reliance was actually moving up a little bit more than the market. There was eventually even a fire in the Jamnagar refinery. That also got glossed over. And it was only when the March of 2008, actually the slide heading is wrong, March of 2008, where the R Power IPO happened. R Power was Reliance Power, which was done by Anil Ambani, not Mukesh Ambani. But after that, the market crashed because there was a Bear Stearns crisis and a bunch of other things happened, and momentum was gone. So if you look at the prices on the right, and this is, of course, again, Reliance has had a bonus issue, so it's 1:2. The prices there were 2x of what it is now. So even then, if you look at current price effective rates, the first time you started to see momentum was around the 300 levels, I think, and even though you would have actually missed out the first 20 or 30% of this rally, or even 40, even first 100% of this rally. Remember, a stock that falls 30% has to go up 50% before it recovers the last last high. So it would have gone up 50%, and then it would have gone up some more after that, before you said, okay, there is momentum in this stock. And then you discover it. And even if you got in at the 250, 280 levels, which is around here, which is around in late 2006, and you were able to exit at the time after the Reliance Power IPO, when the stock fell about 20-25%, you would have still made 2x to 3x, depending on when you got in, of your money. That means 250. The point over here was that this was Reliance, the largest company in India. It had this short period in which it gave a super normal return. That's a 250% return in 2 years. So very, very high. But if you consider that period, and then what happened in the 8 years following it, there was news flow even during this. There was IPCL merger, there was expansions, there was earnings growth, everything was happening. Not much changed after that. Even Reliance itself did a bunch of things like seed in Reliance Geo, which is, of course, India's, I think, largest or second largest player today, and so on. We've seen this growth happen over years. Yet, and this is the next slide, just make it bigger. The biggest company in India did nothing, even though it fell like crazy during the 2008 crisis. You can say this is not because of Reliance, because the whole world went for a toss, agreed. but even then it recovered back. It didn't come back to the highs it saw in 2008 January. It kept it stagnant for another 8 years, and after that, after 2020, I think February or something, is when the company is actually had its next round of momentum. If you take these two rounds of momentum and if you miss them, you would not have made money in Reliance for the last 20 years. So it's like saying that there are very short periods of momentum that sometimes even impact a very, very big stock as well. And it's an interesting phenomenon that says even the great companies go through periods of momentum and then periods of non-momentum, and sometimes the momentum itself gives you reason to check why this is happening. The news flow may not be evident. Sometimes it's evident only in hindsight, but it is there. And Reliance was doing great things all the way. In fact, much about what we call a cheaper internet today is because of Reliance. A lot of the money that it got to fund this extremely cheap internet came from borrowings that came from on the back of a very, very successful oil business, right? So if it's like saying, how come Amazon is able to sell so cheap? They have a very, very successful Amazon Web Service business that funds a lot of their profits, compared to the retail businesses where they lose money. Like in India, they continue to lose. So their US operations, which are profitable, fund whatever their expansion plans are in India and so on. So Reliance used its oil business, which was the great thing in 2007, 2008, to fund the eventual moves into retail. And I think this was there was the Geo came in 2014 or 13. I don't remember when, but that's when it started off. So quite interesting from that perspective. There are times when momentum can be a bad idea as well. That's what you're thinking in your mind. Hey, what happens when things go bad? This is Jai Corp, and I'll tell you, it's a very interesting story because I was at that time programming for, this is 2007 roughly, is when we were programming for, I just left my job, started another startup, and we had at that time we were doing planning to do algorithmic trading, and we were just getting price data. And I thought this was an anomaly. This stock had gone up 100x in a year, roughly, or 100x in 2 years. The stock was at some 700 or 800 rupees at the time. And that is when my what I was writing was, how come this stock has moved so much? It must be a data problem. But it wasn't. This company had gone up from a 50 rupees to 800 rupees in a very, very short time, roughly about 4 or 5 months. And what was the interesting thing here was, there was a company, there is a person called Ed Seykota, who's a world famous trader. He trades in commodities for the most part, and he was mentioning a book called I think The New Market Wizards by Jack Schwager. I was fascinated by the books, and then Ed Seykota had this philosophy that said, look at stocks that are making new all-time highs consistently. So there's momentum in that they're making an all-time high today, tomorrow also they're making an all-time high, and so on. This may be interesting stories to he would trade them regardless of what they were, but I was more interested in what the companies did at the time. So there was this trading tribe, which is a Seykota creation, where you do a it handles the emotional changes that a trader goes through. But in that, one of the presentations in trading tribe, there was only one trading tribe in Mumbai at the time, and I was part of it. And everybody thought the stock was quite fascinating. One of them actually told me, Deepak, you live in Navi Mumbai, why don't you go check, because there's this new SEZs that are coming in coordination with Reliance. Jai Corp is owned by Anand Jain, who is Mukesh Ambani's close friend, and who helped the Ambanis stave off the short sellers in 1983 or 1984, when they had to shut down the exchange because short sellers couldn't settle their trades. Anand Jain was responsible for the rescue of Reliance at that time. And because of that, you got this thing that, they were closed. So if Reliance is going up, then Jai Corp will also go up, and everything will happen. Interesting story here was that there were two SEZs in Navi Mumbai and a Navi Mumbai airport that was supposed to come up, and somehow Jai Corp was involved in all of this. And there was supposed to be a power plant, X number of things. I drove down. I did my scuttlebutt analysis. Okay, I said, okay, let me go check this out. I went to this place, and they said there's an airport, but I saw large fields of land. And then they said there's an SEZ. There was a gated thing which had, there were weeds growing on it. The gate hadn't been opened for I don't know how many years at that time, because they were little shrubs right behind the gate. That means even a car hasn't driven over them for a long time. So that means nobody's come there for a really long time. So these news about, oh, we will develop the SEZ, etc., were very, very premature. I mean, if things were to happen, then there would be site visits, people visiting, setting up boards, all that stuff, which obviously even hasn't started. So this may be like 10 years down the line. And then I immediately realized that situation here is there's not a fundamentally great story. That means whatever it is, the market is just getting excited, and it does all the time, right? Sometimes gets excited about the story way before it has happened. In fact, now is when they are talking about a Navi Mumbai airport coming in. This is 2022. That was 2007. And I relayed my thoughts back to the group, and I said, okay, this is a pure momentum story. This is not really fundamental. But it's interesting because you could argue that you lose money in such a stock, but I didn't. The stock went on from that 700, 800 levels to 1,400 nearly, and then reversed back to 1,200. And I actually have posts about it on Capitalmind where I've said, I've exited because the momentum is gone. Once it's corrected 20%, I don't see this moving. And it corrected far before the Reliance power disaster. It corrected in the middle of October and early November, rather than in January of 2008. So this is in October, November 2007. That's when I said, okay, I'm done. You know what? You got like a 50% or 60% move in a very short time, even on a stock that hasn't got great fundamentals. Current market price, same company, no splits, no bonuses, is at 130 rupees, which means that, of course, that news flow was there, and they did own the SEZs. The SEZs eventually got cancelled or something like that. But they still own that stuff. But yet, the story didn't pan out for even 15 years after this after this news flow has started. The idea here isn't to say that momentum only discovers great stocks. It isn't to say that it only discovers bad stocks, but it gives you a great entry point and discovery point to say, well, you know what, I like this, it's interesting, let me see what's going on under the hood. There are 3,000 plus companies. You will go crazy trying to discover, trying to go through all of them one by one. In general, stocks are supposed to go up, right, if they're good companies. If you like a company, if the company is doing well, its stock price should continuously over time go up. So why are we afraid of buying companies when they're up, and we want to only buy companies at the bottom? This is the foundation of most fundamental investors, is don't overpay. But sometimes don't overpay is with reflection of its own price. Or don't buy at 52-week highs. How does 52-week high have anything to do with the value of a company? The value of a company may be completely different, and the market may have not seen it for ages. You don't only have to buy at a bottom. You can even buy at a top, relative top from the past, and still make great returns. And I've demonstrated how you could have made even great returns in bad stocks, but you could have made supernormal returns in great stocks. Take an analogy that what we do in in jobs, in schools, in the educational qualifications. Why do people say, oh, you have to have a degree from X college, or you have to have it's not that only people from the IIMs or the IITs or the RECs are the best in the country. Obviously not. There are great people. And I would say even in the US, for instance, Bill Gates is a dropout from Harvard. Oracle's Larry Ellison is not a graduate. And how come then graduates are given any preference at all? But people have discovered that over time, finding these gems is incredibly difficult. That means even if you want to find only gems, whether they're from IIT or not, it is an incredibly difficult thing to find extremely good talent, because you have to go through hundreds and hundreds and hundreds of people before you find great talent, and regardless of whether it's but maybe, and this is perhaps evolved as a gating criteria, as a filter criteria, more than oh, you're from IIT, therefore you should know calculus and some Fourier transforms and all that. Everybody knows Fourier transforms, and everybody does not know Fourier transforms. So instead of concentrating what they actually know, you use the degree as a filter. So they're saying, oh, if you've managed to make it through this college or this entrance test or this thing, that means you're likely to be less likely on a, if I select 100 people who have these qualifications versus 100% who don't, there are more people likely to have the talent to become great people than on the other side. So people use that as a gating criteria, as a filter. Now, this is not obviously normal, but we have to think that at a certain level, this is a capitalist economy. It rewards performance. You reward, if you have 10 people that you've hired and one person performs really well and one performs really badly, are you going to say the person who's performed badly has to somehow come up back to the average, so let me give him a salary increment and push down the guy who has performed really well, so that he'll also get back down to the average? What difference? We never do that in real life. If you've done really well, you expect a salary increase, you expect to be promoted. The idea is that you want to promote people who are doing well. Why won't we do that with stocks? They do well, we should be rewarding them. And sometimes they're doing well because they're fundamentally good. And most of the times, if you eliminate a few pitfalls, and we'll talk about those later, this is an enormously good tool for discovery. So you can filter based on stocks that are doing well to say, well, is this a great company because I haven't heard of it before, or I already know this is a great company. This might be the right time to enter it, because momentum is what makes the returns in most of these companies, and especially with cyclicals. When you look at companies like steel, Tata Steel is at exactly two big steel cycles in the last 20 odd years. One of them was the 2003 to 2007 time frame, when it bought Chorus and did a bunch of things, and one is the last 2 years. If you see the stock market returns, again, they're in those two ranges only. So it's a great company, no doubt, but most of its returns have happened in very, very well identified time frames. Both times in which it's done a bunch of acquisitions. Recently, it's done a bunch of acquisitions around bankrupt companies like Bhushan Steel and so on. Earlier, it did Chorus. So it's an interesting tool to work even with great companies, because when momentum goes away, even great companies will falter. The biggest example is ITC. For the longest time, it's not showing anymore, and now it's showing something. But people who bought 5 years ago, who slept through the last 5 years, will tell you there is still no momentum in that stock because it's not gone anywhere for 5 years. So maybe when it starts going away from a 5-year, 10-year all-time high perspective, that's when you start noticing that ITC starts to really make its move. But I mean, I won't say anything. We don't own it, but who knows? Okay, coming back, I think we have that's the end of what I want to say. I'm going to transition this over to Anoop. I think, yeah, that's the end of my thing. So Anoop, stage is yours. I think I hope I did justice to what is something you're really passionate about. You seem to be on mute.
All right, sorry. Thanks, Deepak. Thanks for setting that up really nicely. Before we sort of get into a little bit of the nuts and bolts of how a momentum strategy works and how specifically we here at Capitalmind run our strategy, we'll try and sort of keep it such that folks who've known a little bit about it or necessarily are new to it get to understand what is the underlying philosophy, how does it work, what are the drawbacks, pitfalls, etc., so that you walk away with a better understanding of what is this whole thing called momentum investing. Moving on. So really, at its core, it's a very straightforward concept, which almost sounds too simplistic, which is that stocks that have gone up will continue to go up, and therefore buying a set of stocks which have been going up and then holding them for a period of time till the point that they stop going up is going to give you better returns than buying and holding the index, which sounds again very simplistic, and gets a lot of questions going in the minds of people who have traditionally thought of investing as the idea of buying low, selling high, finding undervalued stocks, doing fundamental analysis to understand the intrinsic value of a stock, based on discounting its future cash flows or earnings. So it sort of doesn't sit well with a lot of traditional schools of thought, and that's why we could get into a little bit of how this tends to work. So this simplistic as it is has sort of worked for us. We've been running a momentum portfolio now for the last 3 months. We started in March 2019. It's now just finished 3 years, managing AUM of roughly 375 crores. It's actually a little more. And over that period, it's handsomely outpaced the Nifty. Over 3 years, it's got about 70% of cumulative alpha, which you would have to then sit up and take notice and say, well, this seems to work, given that it's done what it has over the last 3 years. This is just to set context on the fact that we've seen this in action. We've seen this work on real money, real stocks, in real portfolios, and it does seem to have something to it. So the basics. The basics are fairly straightforward in that sense. Momentum sort of takes quantitative data as its input, which is daily price and volume data. Volume is the number of shares traded of any stock. Applies a bunch of quantitative calculations to that data, which is essentially around long-term price trend, the volatility, short-term price filters, and a couple of mid and short-term volume filters, both absolute and relative. Relative meaning how is it doing in the recent past in terms of number of shares traded versus in the longer term, and then combines all of these to come up with, you could call it a momentum score for each stock in the universe. In our case, the universe tends to be all NSE listed stocks, and then ranks them on that basis. The top few are then looked at. We apply a subjective screen to the top, let's say the 10 percentile of those stocks, to sort of eliminate any obvious problem stocks, which can be stocks which get through the filters, but are not really to be trusted. We try and avoid too much exposure to one particular business group, to any one particular sector, um, and just to ensure that we have a diversified portfolio at the end of it, and that forms a portfolio. And this process then gets repeated at regular intervals of time to decide what stays in, and then whether any stocks need to be exit from the portfolio to be replaced by others. Now that's sort of the not very useful explanation of how momentum works, because obviously we've just shown this one process and mentioned a bunch of calculations, but let's try and make it a little more intuitive. So what does momentum investing mean in plain English? So one is that momentum looks to enter stocks that have proven their price momentum, which means that a stock that's been going up for a little while and has been going up relatively better than the rest of the universe, becomes a candidate to enter the portfolio. Once in, it stays in the portfolio till the time that it continues to show this relative outperformance. It's when it starts to break down or starts to show that outperformance is no longer the case, where it is now trailing the rest of the stocks, is when it becomes a candidate for exit, and it typically then leaves the portfolio at that time. So that's really what all of the calculations that I spoke about tries to do. All things being equal, a momentum strategy or one version of a momentum strategy picks the stocks with lower price volatility. Idea again being that given two stocks which have done equally well in terms of how much they've gone up over a period of time, we would prefer the stock that has done so in a consistent and a less volatile manner compared to one that might have. So the example here is obviously comparing two stocks, but think of this comparison as being applied to the entire universe of stocks, and then the ones which are scoring both high on momentum as well as low on volatility become candidates to be part of the portfolio. And finally, and this is important, is it's really not about picking brilliant individual stocks. it is about picking a portfolio of stocks which satisfy the criteria that we've laid out, and then holding on to the ones that then continue to display price momentum, and then exiting the ones that seem to have completely lost their price momentum. It often happens that you enter a stock and it's been doing really well for a while. You enter it and it then just starts to slow down, break down for whatever reason. It could be something that's been declared publicly. It could be something that's not even been discussed or talked about. But the idea is get out of the ones that don't seem to be doing what you expect them to do. Stay with the ones that are moving strongly along with the market. So, given that, there's a bunch of very logical objections to this methodology of picking stocks and building portfolios, which is, so buy after a stock has risen. How can buying high possibly work? Because that's really the opposite of what every Ben Graham, Warren Buffett, Munger book and talk has mentioned, where you have to be considering value, and buying high is really not going to help. Also, another very valid objection is, aren't such stocks terribly overvalued? I mean, you'll often find that their price to earnings, price to book, price to any metric that you use to value stocks, EV, EBIT, EV by EBIT, EBITDA, free cash flow, everything, stocks, might look really overvalued. Isn't this a high risk strategy that works only in bull markets? That's one of the primary concerns, saying, well, it looks like this could really sort of backfire and blow up in your face. And finally, won't this only work with micro and small cap stocks, because those are the ones that seems to move so far so quickly? And we'll sort of address them a little bit, or partially at least, by using some real examples from the Capitalmind portfolio. We'll talk about stocks that have been there in the portfolio over the last, I would say, couple of years or so at different points in time. Each one sort of represents sort of a different starting situation. So these portfolio examples essentially are, they anticipate, are meant to prove how stock prices anticipate improving or deteriorating fundamentals. Buying even after strong up moves can be significantly profitable, and having specific quantitative exit rules can help protect against deep losses. So example one is of a stock that uh, where momentum ran up, and then it's kind of slowed down even as its fundamentals were improving quite significantly. Just make this, yeah. So just to give context to the chart, essentially it's the price chart of SAIL, Steel Authority of India. The shaded region represents when it was part of the portfolio. So we've marked where we entered the portfolio, which was after it had gone up a fair bit. You can see that around the December 2020 mark. And then we held it till about March 2021. So, we entered roughly in the mid 50s, and, exit when it was in, probably 110, 115, which gave us a roughly 100% return, a little more than that. And what you see, the callouts are changes that happened fundamentally to the stock in the time that it was in the portfolio and then after. And just so in case reading that is difficult, the green and red icons are meant to just tell you whether what happened was positive or negative for the stock fundamentally. So as soon as we entered the stock, which was in December 2020, in early Jan, and it continued to sort of go up after we entered, got to the late 70s, at which point the government announced an offer for sale with a floor price of 64, significantly below the price at that time, which made the stock immediately go down quite a bit. But then the very next day, which was 14 Jan, the offer for sale was oversubscribed. It had seen enough demand, and then the stock kind of resumed its way, its journey upwards. 9th Feb, there was a media report about how good times are going to be coming for this PSU steelmaker. On, I think, before that, on 30th Jan, they just reported 4x profit growth. On 19th Feb, they reported the highest ever hot metal production in the history of the company, and this was obviously a big positive, given that there was significant demand for steel, the price of steel was rising, and there was talk about potentially a supply glut. Um, so all of those were positives. There were brokerage reports coming out in Feb talking about how the target price needs to be up in the 90s. There was one of those, but then sometime in May 2021 is where the price started behaving differently, having continuously sort of gone up quite quickly and quite a bit. It sort of corrected from that point, which kind of hit our exit criteria, which meant that we exit the stock sometime in May 2021. A few days later, it reported its quarterly earnings. It showed 31% earnings growth. Not bad, not great given the circumstances. But then the stock started doing this weird, downward, gradual downward trend after it had exited the portfolio. In fact, in October of 2021, it reported 10x year-on-year quarterly profit growth, its highest ever earnings. It reported 4 rupees of dividend on a stock that was roughly at 100, so 4% dividend yield on a stock that's also gone up quite a bit. You would think all of those would be positive, but the stock just never has come back to what it was in that time when it showed momentum and was part of the portfolio. So, classic example where the fundamentals were playing out just like expected, earnings were growing, but the momentum kind of anticipated all of that happening, which was the time to have actually owned the stock and not way down in October 2021. Had you bought in there after it reported a great set of numbers, you would just be sitting on a tiny loss at this point in time. The next example is about a more sustained growth stock that then takes a breather. This one is a favorite for a lot of people. This is Persistent Systems. This was in the portfolio for more than a year. It came in Jan 2021 and finally exit the portfolio in Jan of 2022. So when it came in, obviously it came in on the back of strong momentum. Soon after it came in, there was some great fundamental news. 14th April, it was named as a star performer in a consulting firm's product engineering services assessment matrix. On 1st May, it reported 64% earnings growth. Just before that, a brokerage had given a price target of 2200. This was at about 1850 at this point. Few days later, it announced that its collaboration with IBM, which is like this hybrid cloud business, was going to be, they were expanding that relationship, which was an existing relationship. They were only going to expand it, and talked about how that's going to help them accelerate cloud adoption for enterprises. Obviously, again, a positive. There was one brokerage report that came out with a sell on it saying 1830 was the price, was the fair value of this stock. Stock didn't seem to mind at all, kept going up. Somewhere in September, it was named best under $1 billion by Forbes Asia as one of the best upcoming companies. It acquired later in September. It announced it had acquired 3 companies. Which were meant to enhance its go-to-market capabilities. 27th October reported 58% profit growth, and it announced that it's going to be adding some 3,000 freshers to its workforce. More brokerage reports came out with price targets of 4,700 and above. There was another one that came out which said 6,000, I believe. So a bunch of very positive buy reports coming out while it was in the late 4,000s, and at that point it started to, and then weird thing happened on 7 Jan when a media report came out suggesting that the company was involved in an app called Tech Fog, which is involved in some kind of a privacy issue, an app that kind of snoops on phones and reports that data to other people, etc. So you wouldn't think that would be a big deal, but for some reason the price started to correct from there. It hit our exit criteria in the portfolio. We exit the portfolio. It continued to weaken. It reported 45% earnings growth in the next quarter. The stock then seemed to go back on its way up, but then since again seems to have corrected from there. Point being, here's a fundamentally strong company doing exactly what it was supposed to do, growing earnings quite quickly, kept doing that. Stock stayed in the portfolio, and then at some point, nothing changed fundamentally, but the stock started to weaken, and at this point wouldn't make the cut to be part of the portfolio. So point being, it has, if you had kept holding on to the stock in Jan till May, now we would really have nothing much to show for it, for having held that stock. This one's an important one, where momentum can forecast, or sometimes forecast deteriorating fundamentals too. And I've seen this a few too many times to not take this seriously. This is LAURUS Labs. Was in the portfolio between April and September 2021, so roughly 5 months. Again, got in on the back of strong performance. Soon after, it reported a great quarter. It said it reported 3x net profit growth. It announced plans to double its capex, and that it was going to target 1 billion in sales in FY23, which is a massive jump up. All great positive news. Brokerage reports were positive. They were talking about the stock was in the 500s at the time. Brokerage report targets were in the 800s, looking good. July quarter, it again reported 40% net growth, looking good. Another brokerage report came out literally when it was in the 680 mark, which is right at the top of this chart, that this is going to go to 800. But then the price started to say something else, where it just started to break down, hit our exit criteria. We exit in September 2021. It then reported a earnings decline in the October quarter, and the stock kind of tanked by more than 30% in a very short period of time. Since then, it has kind of recovered a little bit, but it's still a good 5 or 10% below where it was when we figured out that momentum had gone out of the stock. So there are I had a few other examples for this particular scenario where stock looks promising and then kind of gets into the portfolio, starts to break down, exits the portfolio, and then the next few quarters are just terrible quarters in terms of earnings. This one's an interesting one where momentum reverses just before the stock becomes a falling knife. So this is not one of the wins. So this is Gujarat Gas, which was in the portfolio for just a month. It got in what turned out to be pretty much the top, which was one of the logical objections you might have thought of, saying that wouldn't momentum just get in right at the top. In in this case, that's what happened. Got in August of 2021. Pretty much immediately started to kind of correct from that point. Went down 10%, hit our exit criteria, which is when we exit the stock at a 10% loss in this holding. Just a few days later, PNGRB, which is a government organization, it proposed putting gas distribution companies on a common carrier list, which would have basically taken away pricing power for these companies and was therefore a big negative. So the stock fell quite a bit on that news. A few days, a month or so later, it reported a not so good quarter. Earnings had declined 47%. But even after that, the stock price seems to stabilize for a bit. Another quarter later, it reports 69% year-on-year decline, and the stock basically just craters from there. So it's given up basically 25% from the time that we exit the portfolio, at which point it had already lost 10%. So this particular example is obviously it's a 10% loss on a position, which is nothing to feel good about, is a great reason for thinking of momentum as a part of a portfolio, because of the way it sort of identifies, or can sometimes identify, companies where there can be problems upcoming. And if you're able to avoid some of these, that by definition makes it easier for you to have slightly better than market performance. And the final example, pardon me, is a more recent one, where, and I don't mean this literally that momentum anticipates geopolitics, but this happened earlier this year with this stock called Gujarat Narmada Valley Fertilizers, a fertilizer company. Had been showing decent momentum, had seen some good news flow leading up to in early Jan, which talked about how Europe is going to have a shortage of fertilizers, which is going to drive up food prices. The stock entered the portfolio in early Feb or mid Feb. Um, like literally 2 days later, Bloomberg published a report saying fertilizer markets roiled by Belarus potash. So this was at Putin was talking about potentially maybe invading Ukraine, but not quite. And we didn't really know what was going to happen. Stocks corrected, all stocks globally corrected from that point, right up till the point in I think Feb 24th it was when Russia finally actually invaded Ukraine, and then um, the stock of GNFC kind of then just took off, and this kind of happened with most fertilizer companies. And you can see the news flow that came out early March, mid March, late March about how the global fertilizer markets are going to be in trouble now because a lot of the capacity which sits in Russia is now going to be offline, not available. Canada talked about scrambling to fill global fertilizer deficit. Fertilizer prices surge as Ukraine war cut supply. All of this came in after our simple momentum algorithm had already identified the stock, and it's kind of been up 50%, over the period of from mid Feb to now. And it continues to be part of the portfolio. But the I mean, it would have been brilliant to be able to just sit and say, well, we kind of foresaw all of this. We knew what was going to happen once Russia invaded Ukraine. Fertilizer was going to be in short supply, so therefore add a fertilizer stock to the portfolio. We kind of predict the macros and the impact, and therefore put it in. That would be the fundamental story, but there is none. It was literally the price momentum that told us that there was something there, which made this stock get added to the portfolio, and then it continues to be in there, and as one of the largest positions, and has done reasonably well. So the point of these examples is obviously to show how there seems to be a method to the madness of looking at, or price momentum seems to have a story to tell. Either it is about improvements coming in fundamentals, or the other way around, or something that's going to positively impact a company's fortunes. Either from a macro perspective, from a policy perspective, it could be anything really. And there's a lot happening at any given point in time across the market, and momentum serves as a great way to identify and sort of surface some of those opportunities. So, I mean, the logical next step. So, okay, if you were to assume that it works, what makes it work? So there's a lot of academic research on the topic of momentum, and in fact, I think it's been one of the most studied quantitative investment factors through the history of financial research. I mean, there's been reports written on this 50 years ago, and lots of them examining the whole concept and the principle of momentum. So, what the theory says boils down to these three things. One is the frog in the pan effect. There's this story about how if you keep a frog in a bowl of water and then you start to heat the water, as the water gets hot, the frog doesn't realize and it just continues to stay in there and then finally dies, which is not actually true in real life, but that's sort of the story. The investing equivalent being that investors underreact to information that's arriving, whether it's positive or negative, and therefore they don't necessarily. So as the prospects of a company gradually improve, they don't necessarily see the overall impact of it. So they're not necessarily rushing in to buy the stock all at once when they see that good news coming in. Rather, they wait for a long period of time before getting convinced that there is something happening here. The next is about cognitive dissonance, which is if you already believe a company is good, it's going to take you a lot of information to change your belief that the company is not really doing as well as you thought it was, or the other way around. If you think a company is not so great, it's a bad industry, it's got really pathetic financials and margins and returns, then it's going to take you a while before you agree that, oh, X company in this particular sector is potentially going to do really well, and therefore let me buy this stock. And lastly is this position effect, which is about how most investors like to uh, sell winners to lock in some of the gain, but they kind of delay selling losers. So if you were to think of a stock that's kind of consistently going up at different points in time, there are different investors are kind of selling to lock in their gains, and that acts as a brake on the stock price, which kind of gives the opportunity for a momentum kind of strategy to get into a stock like that, and then kind of ride some of the way from that point on. So this is the theory. but we kind of have our own little hypothesis about why momentum works. Uh, yeah, I'll call it the circle of competence hypothesis. I mean, this is a crudely driven diagram, but basically, x-axis is time, y-axis is price. So if you were to think of a a chart of a company that's going up, you would have, let's say, a company that's not done much for a long time, um, and the stock price has been languishing. But now they're trying to do some cool things. They're doing things which are going to have a fundamental impact. Um, Nobody really knows about this company. Nobody's talking about it. The only folks who probably know are company insiders, and I don't mean that in the illegal insider trading way, but just the way that the folks closest to what's happening will know that okay, this could potentially have an impact. So think Apple in 2005 when they started working on the iPhone. Nobody else knew that Apple was working on a phone. Maybe some folks working on that project start to think, hey, this could be cool. They might really believe in it, and they might start to buy some stock. At that point, that's really not going to do much. But if they consistently buy that stock, it's sort of very gradually, slowly shows some upward movement. At some point, people who closely track that industry, maybe even vendors of that company. So if you were to imagine, take the iPhone example forward, they started working with Corning on the capacitive touchscreen at some point, which had never been built before. So if you're an engineer at Corning, you know that you're working with Apple on making the screen. You don't know if it's going to be successful, but you do think it's interesting, and you might think, well, maybe this has the potential to change the world. I don't know. So maybe you start buying some of the stock. So that circle of people who have now started to believe in that story and start to buy that stock has just expanded a little bit. Maybe some experts were um, tracking that sector day in day out start to buy into it. Stock continues to move up. At some point, it comes on the radar of institutions and analysts, and other folks, who then maybe somebody does a deep dive, and maybe a couple of analysts write a positive report saying, yeah, this could be really good for this company, and we're putting a buy on the stock at a significantly higher target price. And over time, it sort of becomes common knowledge, and then institutions and retail and everyone sort of gets into it, because they now believe in that story. And through that whole process is where the price just keeps going up. But it happens gradually because it starts with a small set of people and then moves on to more and more people. So being able to get in at some point on that trajectory, maybe when the first set of institutional buyers start to get in, or retail starts to get in, is maybe when a momentum kind of strategy gets into a stock like that, and then helps you make your returns. This is just a theory, obviously. There's no way to actually validate it, because that would involve knowing what is going on in people's minds when they buy or sell a stock. So just our theory as to why maybe momentum tends to work. So that's really about how momentum gets implemented, why it might work. But there's four things I think anyone should consider before even considering a momentum style of investing. It's because it's clearly not for everyone. One is that by definition, momentum cannot enter at the bottom, nor can it exit at the top. It's kind of literally relying on what's been happening with the price of a stock before taking action. Therefore, a stock needs to have bottomed out and then gone up by a reasonable amount before a momentum strategy can get in. Similarly, it can't get out at the top, because at that point it is still very much a core part of the portfolio. It's only when it starts to lose momentum that it becomes an exit candidate, as we saw in the 5 chart examples. You're wrong almost half the time. And this is so difficult for a lot of people. I mean, I think coming from our typical education system, where we are scored on the number of questions we get right. In this case, in the case of a momentum kind of a strategy, you're going to be wrong almost half the time, which means you're going to buy a bunch of stocks and then half of them might not even work out. And you will end up exiting them at small or slightly larger losses. You're going to hold on to the ones that work, and then at some point you will hopefully make enough and more from those stocks, which will compensate you for the stocks that didn't work out. The third thing is cash is very much a position, especially during broad market weaknesses. We'll see how that played out in the early part of 2020. But since cash is a position based on whether there are stocks qualifying to be part of the portfolio or not, this means that when momentum comes back into the market, uh, a portfolio like this can trail the benchmark simply because it's not fully allocated. And lastly, and this is a common misconception, this is an investing strategy, not a trading strategy. So, like any long only equity strategy, it needs a long term outlook. If you enter and look at the results 1 month, 2 months, 3 months down the line and say, what's happening? It should be working, it should be giving me um, uh, alpha and excess returns, not going to happen. And I'll talk about what you can expect from a momentum kind of strategy as well. So coming to that first point about having lots of losers. So this chart essentially shows different close positions over the last couple of years. The x-axis shows the number of days the stock was in the portfolio. The y-axis is the return in percent. Uh, the color of the bubble shows whether it was exit at a profit or a loss. The green is are the winners and the purple are the losers. And the size of the bubble is sort of the allocation or the or the position size or the impact it had on the portfolio in terms of gain or loss. So what you will see here is almost half the positions exit the portfolio at a loss. Like I said, you're wrong a lot, but those tend to happen fairly quickly. The bulk of those tend to be figured out in roughly a month or a couple of months. Some might actually hang out in the portfolio for a longer periods of time because they would have shown some strong momentum and then suddenly have lost it and therefore ended underwater. But mostly, most of the losses get sort of cut short in the initial couple of months of having entered the portfolio. The ones that do well then continue to stay in there, and they kind of stay in the portfolio till the time that they show positive momentum. Therefore, the green bubbles will keep moving to the top and to the right, uh, because that's literally the criteria that we've defined for them. Cash as a position. So this one is to highlight how we move in and out of cash. So the chart on the left shows what happened in March of 2020, where um, momentum started to go out of the market sometime in mid-Feb. The number of stocks that kind of checked all the boxes to be part of the portfolio dropped dramatically sometime in middle of Feb, 13, 14 Feb, which is when we started sort of reducing equities and moving to cash and even gold at that point. The Nifty bottomed out in 23rd March. By that time, the portfolio was almost largely in cash. There were very few stocks in the portfolio at that time. And on the right is sort of the impact of that on how things went. So the green line is our portfolio, and the gray line is the Nifty. So having moved fair amount to cash, we were able to sort of cap the downside of the portfolio. But then you will see in the later half of that same chart, as the Nifty started to recover, since we were still in cash and we still didn't see enough stocks which kind of met all the criteria, that continued for a while before we started redeploying sometime in middle or end of May. So if you were to compare just the part from, let's say, March 15th or March 20th to beginning of June, you would see that the Nifty had outperformed the momentum portfolio simply by virtue of being, obviously, the Nifty was fully invested while momentum was mostly in cash at that point. So both these things will happen where if there is a broad market correction, momentum will shift out, move out into cash, and then it will take a while before it redeploys, which means trailing the benchmark for a while. Again, not something that's very intuitive or comfortable for a lot of people, but important to keep in mind when you're looking at a momentum kind of a strategy. And the last one is really about return expectations. The chart on the left shows the trailing 1 year return of the momentum portfolio. It only has 3 years of live performance, which means that's 2 years of trailing returns, 1 year returns. Pretty much all through that, momentum has outperformed, which often gives people the impression that it's always going to be ahead of the Nifty in terms of 1 year returns at any given point in time, which is really not the case. So on the right is the probability of a momentum kind of a strategy, especially ours, underperforming the Nifty. on a 1 year, 3 year, and a 5 year basis. On a 1 year basis, you can expect it to underperform one in any given 3 years, and this is based on backtests, which by definition tend to be optimistic. So we don't think of backtests as an accurate representation of reality, but they're sort of they give you some kind of reference to think about portfolio performance. So um, any long only equity strategy is going to underperform from time to time. What we believe momentum does is, roughly 30% of the time on a 1 year basis will underperform. On a 3 year basis, that probability comes down quite significantly. And on a 5 year basis, which means if you were to invest and then hold for 5 years, the chances that you will outperform the Nifty are, uh, like greater than 90%. Is what the data and what we kind of believe should happen given the nature of how momentum works. So that's what I had. I wanted to end with some final thoughts on momentum investing, which is momentum's actually been proven across markets, time frames, and asset classes. I mean, there's you can reach out to us. We've put a lot of the resources on a page on capitalmind.in, which has all links to global resources on research that's been done on US markets, UK markets, other emerging markets, other asset classes. So this is not just something that works on equities, it works on bonds, it works on commodities, it works on other asset classes. It's been sort of checked over 2 centuries of data, and it's kind of stood out that momentum seems to work at outperforming the markets. It was in fact called the premier anomaly by Eugene Fama. He's the father of the efficient market theory. He's the one who came up with the idea that you can't outperform the market. But ironically, it was one of his PhD students who kind of came back with with the research showing that momentum seems to work. To which he finally said that yeah, it does seem to work, and can't seem to be able to explain it. Momentum assumes that someone somewhere knows more than you do about a stock or a company or a sector. So it's literally, in some ways, it is the intellectual opposite of many other ways of picking stocks, which is you get deep into a company, you get to a point where you feel you know more than pretty much anyone else around about a company or a sector, and then you invest because no one else knows that there is potential for outperformance here. Momentum, on the other hand, assumes there are groups of people who know more than you do. You're going to rely on them. The other thing is momentum does not rely on being right all the time. We talked about how almost 50% of the positions are losers. But it relies on winning more when it's right and losing less when it's wrong. And if you can kind of do that on a consistent basis, you will come out ahead. And just mathematically, if you were to try that out, where you tossed a coin and then you took away 10 rupees every time you lost and gave yourself 20 rupees every time you won, you would over the long period of time come out significantly high. In India today, I think as of March end, there's over 300 companies with a market cap of 10,000 crores and above. More than 470 companies with a market cap of 5,000 crores and above. So if you were to think of these companies as your potential set, that universe is only going to get larger over time. How do you stay abreast of what's happening across sectors, companies, and therefore know where the potential lies is a question maybe any active investor needs to answer for themselves. Obviously, if you don't want to go to that trouble, obviously the index is there, which is automatically always going to have the largest companies at any time. But think about how will ideas surface? How will you come up with themes? How will you come to know where action is happening? That might give you the potential for long-term outperformance. And obviously, lastly, momentum works as a long-term strategy only, and not as a short-term trading kind of a thing, which you do for a month or so and say, well, it works, it doesn't work. That is, you'll probably be disappointed if you look at it in that way. So that is about it. Yeah. You mute. Deepak, I think you're mute.
No, that's me, always talking and then the computer shuts me off. But yeah, thanks, Anoop. This was a long thing. I'll let you take a little bit of a break. I know you've been talking for quite a bit. But one thing that I do want to add is, I personally have my money, and Anoop does too, on on the strategy itself, and it's a retirement, saving for me. And I think everybody thinks of this as, oh, it gets in and gets out. What difference does it make? As long as it's a portfolio, think of it as a box by itself. It's a whitish box because every day you get to know what your portfolio has, but it's not a black box. But the box itself is what you care about. That it doesn't matter what you sell. It's like, if you're a shopkeeper, you don't really care about whether today your shampoos are outselling your soaps and tomorrow your soaps are outselling your shampoos. You're going to stock more of what sells more. In a way, your idea of a stock portfolio is, overall it should make money. This is unfortunately a problem because we want all our stocks to be top performers. Therefore, we look at all of them critically, but I think we should look at portfolios rather than stocks. Quick note on disclosures. Let me just okay. We have a nothing, of course. Back to, we have ownership in some of these stocks, and we've traded them, and we've talked about them. People have seen them in the momentum portfolios, and there are risks, obviously, because even momentum is a long only strategy. So when the market goes down, it will go down. So you don't have to think of this as a holy grail of investing. Remember also that you need to understand your risk profile. Even consult a financial advisor before you invest in such stocks. Now for Q&A. So that's all we have to present. We've not gotten into nitty-gritties of how this is not an education session on how to build a momentum strategy, but more into, I think the idea here is to surface that these are not in isolation, only price trends based performance. There's sometimes great stories happen right through, and great warning signals also come right through price based determination process. Sometimes, be long enough in the market, initially we think that there's a evil hand, somebody manipulating these stocks so that when they go up, there's good news before they go up and all that. But I think there's no evil hand really. It's just the way the markets are. It's a collective system, and therefore it works as everybody sees it, not and therefore it appears like the world is conspiring with you or against you at some point, but in reality there's no conspiracy. It's just the way markets are. And I think quite interesting that the markets collectively have a very different behavior than us individually sometimes. Cool. Should we start? The difference between a multi-bagger and momentum. I'm not sure there is a difference. I wish I could say that they're the same, but they're not. So a multi-bagger is simply something that just gives you more than 100% return. So that means you enter at X and it gives you 2X back. But it doesn't, I think we focus too much on multi-baggers. If you put 5,000 rupees on a multi-bagger, it doubles. It makes just 10,000 rupees. So people are very excited about these IPOs. Oh, IPO may double ho gaya, all that. What is the point of that? It's like because if it's a very well subscribed IPO, you probably put 12,000 rupees. For most of you, if it doubles, 12,000 rupees is like hardly anything that will change your life, except you got double. What matters more is how much you've invested in it as a percentage of your portfolio. And is that a meaningful position in overall? If you have a 50 lakh portfolio making 12,000 rupees, I don't even know if that's useful. That's like 3 days or maybe 10 days of returns in a liquid fund, or a debt fund or a fixed deposit. So you should care about not multi-baggers, but position sizing in the portfolio. And sometimes if you keep adding on to a stock while it is going up, you will never get that 100% return, but in absolute terms, you make a significantly higher amount of money than if you had just invested a little bit in the beginning and let it ride for 4x or 5x or whatever it is. Next question is, while backtesting, do you take account of circuits because small caps may not offer exits? Anoop, do you want to take that? Or?
Yeah, so I think one thing is backtesting in there is always an approximation of what happened in the past, never an accurate representation. So this is one of the limitations of relying on backtest results, where some of the things that the backtest would assume would actually not happen in real life. So to your example, if there were some small cap stocks which are only hitting circuits, then it would not the backtest wouldn't be able to figure out that you couldn't have exited those stocks. So you will literally have to go back, look at the results of the backtest and say, okay, this would not have happened. Instead, this stock would have been exit not at this price, but at a price much lower than this. And that, those are some of the things we do to kind of correct what our backtest results are. Um, but you do have to get into the exact nitty gritties of the backtest to be able to say, okay, this is what happened step by step, and what of those things would actually not have happened in real life, and kind of adjust for them.
Cool. What's a typical period in which you recommend calculating momentum? I'll just quickly take my thoughts on it. Uh, and then I'll pass it on to Anoop because he has a more refined, better look at it. But I think in general, you have to figure out what parameters work for you. Many people define momentum in different ways, but largely most of them converge on similar stocks. So you might notice there are multiple people saying that they run momentum portfolios. They may have different approaches to them, but you might end up eventually picking the same stocks because a stock that's in momentum will meet a lot of criteria. Now, your criteria to do it could be different if you're more sophisticated. But I think over here, time periods in India will probably be slightly different. In commodities, will be different. So different markets typically require different time period, look back period analysis. But the actuals, I think, Anoop, you have more, I guess, on that.
Look, the core, as you know, it can vary depending on the specifics can vary, but the core principle is you're looking at return over a certain period of time. Now, the traditional definition is 1 year. You could just look at all the stocks, and then rank them by return over the last year and say, here's the top 10 by return over the last year. And then you can sort of from there refine it a little bit by making it a composite metric, that is taking the longer term return and then also layering in the what it has done over the short term, and then come out with a composite metric that represents momentum. So the principle stays the same, which is a simple one: which stocks have done better over a certain period of time, and then picking the ones which have done better.
Cool. Next question is by Janvi, which is on which data do we exactly move to cash in partial? Why not allocate more to the stocks? My initial thought over here is like this: there's a reason why momentum not. So think of this. Let's say there's a universe of 400 stocks. You have to choose 20, but only 4 are showing up. Do you say 25% per stock and put all your money into those 4? Or do you not think that the market is giving you a signal that there is no momentum and therefore you should be in cash? I think the answer to this seems to be don't over concentrate, because those 4 stocks may just be in momentum for a different reason. They may not the whole market seems to have lost momentum. So you're actually better off with cash as a position. So 4 stocks out of 20 means only 20% of your portfolio is allocated, the remaining is in cash. This actually served us well in times like COVID. So that may be a reason to move to cash. Your approaches may be different. It just changes the risk profile very dramatically if you were to fully allocate and not have a cash position. Anoop, do you want to add?
Yeah, it's a risk management part of the risk management where every stock has a starting allocation based on the amount of volatility it has shown, and the idea being that if it moves the wrong way, it should not damage the portfolio beyond a certain point. And so when we are left with a small set of stocks, we will only allocate up to the point that the algorithm allows, and the remaining will go to cash or some other kind of risk-free security.
Yeah, I think also interesting points over here is that having a position size limit limits the risk on that individual position, which is a problem in portfolios in general. Over concentration in like 25% per position, for instance, you exposed to the risk of the unknown, and the unknown can happen simply because it is the unknown. If you knew it, it would not be unknown. So I think that's
What
that's
are
pretty.
some exit indicators? Essentially, I mean, there are some short-term price and volume indicators which are essentially like binary, yes or no. Which, when a stock fails them, that's when it becomes an automatic exit at that point.
Okay, the next question is what should be the suggested volume filter? Okay, this is technical. I'll let Anoop answer that.
There is no suggested, right? I mean, you take an underlying hypothesis saying this is what the volumes represent. Do rising volumes tell you one thing versus falling volumes on a stock? Rising volumes are fundamentally, a positive for a stock, while falling volumes indicate that people are, or a stock rising on rising volumes indicates more and more people are getting interested in buying the stock, and the opposite when volumes are falling. So if that is the underlying, hypothesis, then how do you quantify that and then test out different versions of it to say what will give you the, a potential improvement about over not even considering volume as a criteria.
Cool. Can we use momentum for long-term investing? I can tell you that I have no problem in looking at a portfolio for long-term investing, such as momentum. Now, it's a strategy, right? It's like saying I invest in a mutual fund. The mutual fund, how do you know the mutual fund is holding your stock for 10 years or it is selling it on a monthly basis? Currently, the best performing set of mutual funds, I won't name them, but they are actually significantly churning their portfolio every month, yet they're giving you great returns. So does it mean that you're going to say, no, I'm going to question why they're selling these strategy stocks? And you won't even know that you are, unless you do a lot of analysis on them. In a way, the fact that something is churning, that makes no difference to you if after the churn costs and after the analysis of the risk they save you from by being in cash, for instance, is it might actually give you superior returns compared to being in an index, which is your next strategy. It just, I think, for me personally, I have about 30% of my money in it. I have money in all the strategies we have, so I have 35% of my money in momentum. But this is entirely left to you. It's not something that I would say. We have an advisory thing on, oh, put X% of your money. I think it's left to risk profiles, individual ability to take risk in equity, the amount of money time you have left. Because if you need cash flow in 2 or 3 years, you shouldn't be in heavily in equity strategies in the first place. So a lot of that would determine how much money. But you have to actually think of this as an independent strategy, not as something that's short term or long term. That's my thought process. Ashdeep would like to know if the momentum PMS of Capitalmind will be good returns until what AUM, and can we build a corpus with the capital momentum small case to enter the PMS a few months later? Well, my view in the first part of it would be that we can't, of course, estimate what returns will be. We don't know, and therefore we can't say. But of course, every strategy, regardless of what it is, will change, or returns will change according to AUM. We're at about 375 right now. I don't think this current scenario is going to be a problem for us near term, but I think if you told me, Deepak, can we handle 100,000 crores? The answer would be, of course, everything has to evolve. But I think over here, whether it is good returns or not, I mean, this is not something we can predict. The idea is that this strategy has worked in the US, in Western markets, in different markets, in much larger numbers than anything we're talking about here. We are like a fraction of the worldwide momentum universe. So too early to call that. And I think, yes, you could build yourself a corpus. Whether you should do it with the small case or not, the small case is a self-executed portfolio. You don't have much control on the prices and the mechanism of entry and exit into the portfolio. You're pretty much restricted to what small case gives you. So it's useful for a little bit smaller portfolios, when you reach the 50 lakh limit, it becomes very unwieldy, because your positions, if they place market orders, can move the stock significantly, which is why we suggest that the management is more efficient in the PMS. So you could transition, of course, if you like the strategy, if it works for your risk profile. Anoop, anything to add on that?
I think that is a good question overall, and it is kind of a problem to solve, because it's one thing to run a model portfolio and then talk about great returns versus actually taking money and buying and selling. And so far we're at about 380 odd crores, and it's worked fine, and we've not seen any negative effects of AUM, which I think the just in the current shape or form it can scale by about 2 or 3x. At which point we will be. I mean, it's an ongoing problem for us to solve, to figure out, okay, what's the best way to make sure we have the right number of stocks and we are entering them, executing right, to kind of leverage what the strategy offers. So it is an ongoing problem to solve, but we don't foresee that being a challenge for at least a while now.
Divyesh mentioned that momentum works across different levels of efficient markets. Premier anomaly, therefore, but there's a degree of outperformance decrease or increase with more efficient markets. I'll tell you what, the US is efficient. Everybody says that. And yet, ARK as a fund, of course, they're not a momentum fund, but they invested in stocks which have a lot of momentum. They don't have a stop loss, so they lost a lot of money when these stocks came down. But they made insane supernormal returns last year. That was momentum playing its part. It may have been in great companies, Shopify, Netflix. They were good companies. They had a phenomenal run. And if you were invested in those stocks anytime in the last 5 years to maybe mid of 2021, you had extremely good returns. And that's any momentum strategy that focused on US stocks would have picked them and perhaps exited them when they fell. Netflix has fallen 70, but you wouldn't have lost 70 if you had exited in a Netflix kind of an environment, in a momentum kind of environment for Netflix, because it would have gotten out of a momentum strategy by definition. Having said that, I think there's no measurable difference. I haven't seen any measurable difference. I can tell you examples that even the largest, most efficient sort of, say, markets see momentum on different parameters in different ways, and sometimes insane momentum. I mean, what happened in the US with tech stocks was incredible. It was even bigger momentum than what's happened in India, way bigger. So, to just from an example perspective, I think to assume that more efficient, that means less the degree of momentum in market, and therefore anomaly will be smaller. I think that's wrong. You can prove an example with 100 things, but you can disprove an example with one. And if you just take one and it doesn't work, then that theory itself doesn't work. But Anoop will have more. I mean, you'll probably have more detailed.
I mean, the thing is that if it's outperformed over decades and centuries of market data, then you'd have to kind of at some point say, well, yeah, this works. The degree obviously will change from year to year. It was great in 2021, 2020, not so great in 2018. So it really depends on your horizon. If you know that it's going to work over the long term, and that's all we're trying to do, right? We're all trying to outperform the benchmark. It seems like momentum is fairly certain it can outperform the benchmark.
Perfect. Umesh, is there a target on the max number of stocks in the portfolio? Would all have the same folio size? The answer to this is, I mean, Anoop, you probably have it, but roughly, I think your position sizing is also part of the algorithm of momentum, which means it's not like everybody is given exactly the same portfolio size. The max number of stocks is also a little variable, so it may. At any point in time, I don't think there will be a hard upper cap on the number, which is slightly larger than 20, slightly larger than 20 perhaps. But I don't think at this point that there is a hard cap on like exactly 20 stocks, exactly 21 stocks. But sorry, more to you, over to you, Anoop.
It's really a function of where the momentum is playing out at a given point in time. If it's largely in large and mid caps, then you see a smaller number of stocks because you get given their volatility, you can take slightly larger positions, which which tend to be in the 5-6% range. If the momentum is largely in the small caps, then those weights tend to be in more in the 3 to 4% range to start with, and then they might grow from there. So obviously, the number of stocks is a function of where the momentum is in the market at a given point in time. So, for example, now it's more in small caps than in large caps, and therefore there are more stocks with smaller allocations as opposed to fewer stocks with large allocations.
There you go. With bigger capital, does momentum investing loses edge? I think many big hedge funds in the US are practicing this style are underperforming major. Are
See,
they?
we've already talked about the AUM question, right? Where, yeah, AUM is a consideration, but we haven't really seen any constraints on the kind of stocks we can get into and out of based on where we are, and we don't think it's going to be a problem for a while now. Also, we've done some optimizations in terms of how we execute. So in the PMS, for example, initially it used to be a trader sitting and placing buy and sell orders. Now we have an algo that's placing orders, which actually breaking orders down into small chunks and then placing them throughout the day. With there are some checks and balances to kind of buy more when the prices has fallen a little bit and buy less when the price is beyond a certain threshold. So that we found helps in sort of optimizing the prices that we are buying and selling at. And if we keep refining that, I think we'll be able to do more with more AUM.
Yeah. Upinder, what are the what are the risk prevention mitigation steps one can put in place to protect base capital? Can original capital be 100% preserved? If yes, how? Answer: I would say if you want 100% preservation of capital, you shouldn't be in equity markets, especially not long only strategies. But here's the thing, okay? So you have a strategy that will go up and down with the markets. It's long only, so it's obviously affected by broad equity downtrend. But you also have a strategy that can react to prices and react accordingly. Would you say I want 100% preservation of capital in this strategy? Then it's not a strategy for you. Or you would say I'll keep my 100% money in a fixed deposit. Whatever interest comes, which is technically 100% capital is preserved, the interest that comes I will take out and put into a momentum strategy. So you put, I don't know, 10 crores or something into a fixed deposit, and then I'm just giving a rough large number just to give an idea, and then the interest on that on a monthly basis can be taken and put into that way your base capital is preserved in the fixed deposit, and this allows this strategy to move up and down where you are. You cannot protect 100% base capital, period. I don't think anyone who tells you that, you should be very, 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 unless they're selling you like government bonds, that too short term. Because even long term government bonds, as we have seen in the last 2 months, have a price risk because they can fall. The long term government bonds have fallen approximately 7%. This is the safest government bond because there will be no default. Yet these bonds have fallen 7% in the last one. So there is nothing safe in the market other than like a fixed deposit by a scheduled commercial bank in which you invest less than 5 lakhs, which is guaranteed by the government. Otherwise, very little, only things guaranteed in the market are death and taxes, right? So Achintya asks, is there any human check the rebalance recommendations undergo? The answer here is yes, and I'll let Anoop expand.
So yeah, there is a subjective screen to the shortlisted stocks. The idea being to avoid too much exposure to a particular sector, too much exposure to a particular business group. You don't like at some point in 2020, all the Adani stocks were showing up as momentum candidates. We didn't want to like allocate 20-25% of the portfolio to just stocks of one business group. So that won't happen. Plus, there are certain stocks which are just questionable, even though they meet all the quantitative criteria. There's just something not quite right about them. Either it's publicly known or there's something that's call it instinct, call it whatever, but there is some of that to keep a few of those companies out.
Cool. So the next question is by Shankar Nath. There have been stretches of 2 years or 3 years in India where momentum investing did not work. Why is what might be the reasons for that? We've seen underperformance. I don't know if it's 2 or 3 years, but there has been underperformance at some point for a while. Such strategies, since they're longer term, tend to take time sometimes to demonstrate themselves. And as I said, even the whole Indian market, I'll give you the Indian market as a whole. Okay, so Indian market, if you're only a Nifty investor, then you have seen 2 periods of momentum, and that those 2 periods pretty much define almost all of the returns you've had in the last 20 years. That period is 2004 to 2007 end, and 2020 end of 2020 roughly to 2020 21, about a year of that in crazy momentum that has happened. um, it's just 2 periods of momentum. Otherwise, long-term returns have been the order of 10% a year for most of that time. So you if you
So
think of
let me phrase it, answer it maybe differently. Think of the same question, except replace momentum with any other school of thought. Call it
correct.
value, call it quality, call it I don't know, pretty much anything. Value has not worked for I think 10 plus years now. It started working in the last couple of years. Quality used to work, but if you were to look at the last couple of years again, you would see underwhelming results. So whichever philosophy you take, it's going to go through these periods of where it's not really doing much. Specifically about momentum, uh, the worst kind of markets for a momentum strategy are a gradually downtrending market with no clear sector leadership, where no set of stocks is showing sustained momentum over any period of time. So you keep moving from one set to another as they each keep losing momentum, and then essentially very sideways markets across the board. Markets overall could be sideways, but certain sectors could be doing better than others, in which case it's fine. But if everything is doing exhibiting that behavior is when momentum does not do well. But yeah, just like pretty much any style of investing is going to underperform at certain periods of time.
Cool. How to avoid derailing off momentum in life? Okay. Just trying to relate momentum and investing with momentum in life. See, here's the thing: if you're a cricket fan, are you going to stop betting on a batsman who's in form, bowlers in form? That's when you're derailing off of momentum in life. Right? As humans, no, we love to support the underdog. So that means whoever's not supposed to win, and if there's a 1:1 match with someone else who's supposed to win, we love it when this is the Amitabh Bachchan style of the 80s, and I got beaten up and then I got up and I beat up all my. No, that is the traditional thought process that somehow seems to drive investing. You always want to fight for, oh, is it 52-week low? I will buy this stock and I will look like a hero when it comes back up and all that stuff. But in momentum in life, otherwise, is everything else is seems to be more natural, right? This underdog support is supposed to be is like uh, just an emotional thing. In everything else, you want your children to do score good marks. You want to be first in X, or you want to be known for something and all that stuff. You want your life to have upward momentum no matter what you do, and you'll bet on other people who have that upward momentum in life. And that betting on other people can be, I like this particular, say, batsman in sports, or in or a player in sports, or something in some other thing. I think overall, we get jaded with age, saying there has to be change, and that is why we would kind of derail off of momentum. But in general, like for instance, Tesla was an underdog at some point, because it was getting beaten up, short sellers, this, that, and all that stuff. And now it's one of the largest companies in the world, fairly short period of time. And now they're saying, well, Tesla is bad because it's, X and it's so big now, and how can it grow and all that stuff. And I keep thinking of this and saying it's the same company. It's just 1.5 years since it was beaten down to a fraction of what it was. In that last 1.5 years, it has grown quite considerably. Since then, it has demonstrated that it can execute when everybody said it couldn't. Well, not maybe yet demonstrated fully, but still, I think we should, in general, appreciate the philosophy that sometimes there is great good that comes with people or stocks or things that are doing really well. And it is not always that everything goes back to being lousy. In fact, the one thing I would say is that if things are going well, just the warm, fuzzy feeling that things are going well will make the next day even better for you in life. This is very philosophical, but Shiv says hello. Well, hello from me, Shiv, and thanks so much. And you, Anoop, over to you. I think you're on mute. Okay. Cool. That was a lovely way to end what has been a very interesting webinar. So remember, please, if you are looking at the PMS, it's a minimum of 50 lakhs. That's the SEBI recommendation. Our fees are 1% as our management fees. We don't charge a profit share. We wish we did, but we don't charge a profit share. That's my problem. It's all bad on me, but I feel it's better for you, if in the long term that we don't charge a profit share. But also we have a small case and premium as well, where the small case and premium portfolios will contain a momentum portfolio as well that you can participate in. You can connect with us on Twitter at Capitalmind_in and cm.social/PMS-connect is where you can have leave your details, and our team will get back to you with more information and questions and risk profile and so on. Remember again, none of this is for advice. We hope you enjoyed this seminar and webinar, and from me, all the very best. So, I'll leave it to Anoop.
No, thanks everyone who took the time out to listen in. Hopefully this was useful in terms of giving you a little more insight into how we manage our portfolio and how everything within the portfolio kind of works. Feel free to reach out to us with specific questions. Happy to help. Thank you so much. Have a great weekend.
Have a good one. Cheers, and thanks for listening.